Hey everyone, in our latest Trade to Black podcast, we discuss how the equity side of investing in cannabis has been very, very challenging to say the least over the last 18 months. MSOs down over 60% for the year and as high as 80% from its all-time high. But in our latest discussion, we talk about the private side and how this one specific cannabis fund is providing over 15% annual returns. Sound too good to be true? Well, it's not. We break it all down right now in our latest Trade to Black podcast. Hey everyone, welcome to the Trade to Black podcast. I am your host, Shad Dales. Again, we appreciate obviously you logging on right now and listening to what we have to say and all the information that we share. But we want to know what you want to know. So give us your feedback. Leave a comment below. Feel free to share this video. And as well, click on that bell for notifications. And if you like what we produce, then subscribe to our channel, because today, another interesting guest that we have on, we had him on a couple of weeks ago. He is the co-founder of the Pelorus Equity Group. Rob Sechrist joins us once again. Rob, great to have you on. How's things?
Good. Good morning. Thanks for having me.
Good to have you. Ben, good to see you. How are you, sir? How was your weekend?
Weekend was great. Yeah. Crazy football games, Buffalo and Dolphins. So watch that one. That was crazy. Just watching the equity markets now. Interesting times to say the least.
Yeah, well, let's talk about this. Equity markets, and something that obviously, Rob, that you don't focus on, which is actually probably not a bad idea right now. So let's recap some of the conversations we've had with you in the past pertaining to this cannabis industry and the challenges that equity investing in this space has been for many, especially over the last 18 months. So some of the focus and direction that you think investors should be concentrating on that they may not be aware of. So can you talk into detail as to like what those investment strategies are? And as we obviously further this conversation going on, talking more in depth about you, your firm, and your fund specifically.
Sure. So I think that for your audience, they're probably more in the publicly traded equities. And so what my comments have been there is that this is an emerging market. It's very difficult to glean the information that you need as a retail investor out there. And that if your strategy is to be betting on legislation to pass that makes removes the prohibition of cannabis at the federal level, that's a difficult position to start from your thesis. And unfortunately, I'm just new to your show, so I hope that I'm not, saying this and nobody is able to utilize that strategy at this point. But that's always been our strategy from the private side, where we have no volatility from our share price.
Yeah.
And our strategy doesn't matter one way or the other. I shouldn't say it doesn't matter. It's only upside for us. But our existing strategy holds firm, even if no other legislation changes ever. And so we're good in this spot right here. And that's my personal thesis of how I invest. And that's how our company is structured as well.
Okay. So Pelorus Equity Group, I want to get an understanding, because as I said, you've come into a lot of these conferences. You're our keynote speaker. So people are obviously looking to advice and direction. Your model, you focus on mortgage lending. It's as opposed to, say, other publicly traded cannabis REITs. You've been a keynote speaker, as I've said. You've garnered a lot of attention. So how exactly does the model work for our viewers to get a better understanding?
Yeah. So just to clarify, so we were the first dedicated lender to the cannabis lending sector. Prior to that, we've done 5,000 loans for more than $5 billion. So we're a very knowledgeable lender for bridge lending and value add type lending. And so in this particular sector, when our local congressman at the time, Dana Rohrabacher, passed the Rohrabacher-Blumenauer amendment that defunded the Department of Justice from any prosecution of a cannabis-related business, we realized this was the largest newly created asset class in the country from our perspective. And we had the skill set to lend on it. So we immediately pivoted, and that was in 2014, to really researching this. And by 2016, we were originating our first transactions. And quickly thereafter, we realized this cannabis asset class, which is a specialty use asset class, most similar to cold storage, data centers, or lab spaces, is so vastly superior than traditional lending that we ended up leaving the non-cannabis lending sector completely And in 2016, we've only been doing just cannabis since that time. And today we've done about $463 million worth of transactions.
Wow.
It's about 71 transactions, with more than half of that portfolio already of paying off and being recycled. And we've lent on more than 4 million square feet, which, you know, IIPR has 8 million square feet. So we've done 50% as much as IIPR when you look at how much square footage the facilities that we've created.
463 million. That's a lot. I know you wanted to ask something pertaining to that, Ben.
Yeah, I know your model works on, you're more of a mortgage lender as opposed to taking ownership of the actual properties and then renting those out to prospective cannabis operators. Can you tell me a little bit about the difference between your model and, say, some of the publicly traded REITs that actually own the property and lent it out? Is there less risk on your end, or what's the thinking behind that model?
Sure. So let's just clarify the universe. There's equity REITs, which own the properties directly, which is an IIPR, or innovative industrial properties, or there's mortgage REITs, which mortgage REITs just means that you get the tax advantage, but you're a lender. And so ourselves as a lender for the tax advantage, and there's a couple of other publicly traded mortgage REITs on the NASDAQ. The difference, first we'll talk about equity REITs. An equity REIT, in that scenario, the IIPR owns the property. What's different there is that they are cashing out the borrower, or putting the borrower essentially has no skin left in the game of that transaction. So if you were to give them $100 million or whatever the proceeds are from that sale, a portion of it might be going back into the property potentially, but they would have lent on that for future value. So that's a net. There's no net gain there. But whatever the rest of the cash is, they're supposed to use that to put it back into the business or wherever it's going to go. But it doesn't necessarily go back into the property to increase, or back into the business, or into your particular collateral. It probably does. But in reality, it's a sale, so it's not required. And so the disadvantage of that model is, from our perspective of doing more than 5,000 loans, is that anytime you decouple the borrower from having a skin in the game interest in the transaction, our threshold that we want to see is no less than 25% of the whole ratio of the transaction. When you do that, you run the risk of, when you go through difficult times, that the borrower, if they have no money left or incentive left in that transaction, it's easier for them to walk away or focus on more profitable endeavors that they're making more money on, than to burn their bandwidth of energy on this particular transaction. So that's one aspect.
Okay.
But the most important factor, and I don't think that people think about it this way, but they should, IIPR, an equity REIT, is way out on the risk profile than a mortgage REIT. And why is that? That's because the mortgage REIT is an equity REIT is the first loss leader of a dollar. If you have to resell that property that IIPR owns, or if you have to replace the tenant, if the rate on the new tenant is lower than the previous one, then that value of that property now is less. Right. And so you just, that delta of that property on your balance sheet, whatever it just went down, or if you had to sell it and retrade it, or whatever it happens, whatever disparity is, you can go up and you can go down. So you get accretive to the value of the properties over time in a more mature market. And that was what I think everybody in the IIPR investment thesis, which I think is a great company. I'm just talking in broad terminology here. I think everybody, when IIPR came in the sector, thought that this is always going to go up. There is only accretive value to the properties. But if you would have asked somebody like me, I would have said, you're basing all that information on no history, nothing in the past. This is a brand new market, and you're giving comparables to mature industries. And in reality, there is only going to be more and more. There's only going to be more. There's going to be more efficient forms of capital that continue to come out, and that's even without any regulatory things happening. And as more and more efficient capital sources come out, such as debt people and other things, the leases become less attractive. And so you're going to get yourself into a situation, if you wrote your lease 3 years ago,
Right.
where market rates were 15% for debt, but today they might be 12, and in another 5 years they might be 8. You're still stuck in that lease that's continually
Yeah.
escalating every single year, and now you're in a situation where your own lease rate has priced you out of the market because you never took into account the efficiencies in the market that are always going to be gained over time. Not to mention if there's any legislative reform. If you get legislative reform, what happens now is all those tenants in every one of those transactions theoretically would have had less cost of capital. So IIPR is going to run the risk that these guys, they don't have any skin in the game left in these transactions, and they're all going to come back to IIPR and say, look, we're going to just go and start another business or go do something else because we can't afford to be in this lease rate anymore. It doesn't make sense. And so the day that IIPR rewrites that lease, the value of that property just changed. And so those are some of the things you need to think about, is that on an equity REIT, not only do you get that accretive value, but you get the downside as well. As opposed to us, there is no accretive value add to ours. We make a loan. That loan might be, $10 million. We're going to get back $10 million.
Right.
So
Now,
you're not exposed to the value of a depreciating asset like a traditional REIT would when mortgage rates are rising,
correct.
and then you're not. Okay.
So what's happening is the loan to value may be changing of what the value is of our security, but there's nothing we can do about that. But on our bridge lending program, we require 40% from the borrower day one. Plus, we have personal and corporate guarantees. So we are not the loss leader. And so if we took that property back and we had to reposition it, if by chance we were to have taken a loss on the repositioning of that asset, which would be very likely that would happen, we would have the personal and corporate guarantees to go against. But we have that 40% protective equity that we should theoretically make it through. And on top of that, our bridge loans are in 18 months. We purposely set the term shorter than what we think is the life of that loan so that we get another crack at the apple to see if any market conditions have changed. When the loan comes to maturity, you can foreclose for non-payment, but you can also foreclose for term. We can say we are not going to extend this loan. You don't have any other options. You must pay us off. We assume that in some cases they may not be able to pay us off. And in that scenario, we would have them come in with a principal reduction. Or if they can't do that, we would rather force them to sell that piece of real estate while we still have the maximum equity protection. So if we saw an adjacent city that immediately joins our building, let's just theoretically, it was right next door, that has a better tax rate than the city that our building is in, theoretically, we know that that's going to compress lease rates because next door in a different city has better tax rates. So we know in the next 2 years when those leases come online and those buildings come online as they get built out, that could affect our value. So we would get way in front of that and say to our borrowers, look, we believe that this is going to be some compression here. You have a choice, and we might say it 3 or 6 months out. You have a choice of doing a principal reduction back into where we feel that will equalize where we feel comfortable, or we're letting you know we're not going to extend, so you're going to have to sell this asset. And so we will force them into a position where we have maximum equity rather than running it out and waiting another 2 years and then having to deal with it then.
Rob, you said you launched in 2016, this fund. It's now 2022, 6 years later, and you're sitting at 63 million, you said?
Well, just to clarify, we entered this cannabis lending sector in 2016. We launched the fund in 2018, and today our assets under management are about 316. So we've had capital be recycled and put back out.
What kind of returns are you doing? I know you're not on the equity side, but in these market conditions, it's obviously very challenging for small to medium-sized companies to have access to capital. But your fund itself, like what kind of returns are we talking?
Yeah, our investors are making 12 to 15% net returns annualized. We make that on a monthly distribution. So theoretically, you're making about 1% or slightly more every month on average is what we're targeting. For every full year we've been in operation, we've done 15% net unlevered. And this particular year, we're targeting 12, but that was only because we rounded the end of this year or this last year with 120 million cash. And we with a fund of about 250 million, so 50% of the capital was idle. And that we're still going to do a 12% even with that happening.
Wow. in these conditions. That's incredible. When I look at MSOs, it's down 60% this year alone, 80% on the all-time highs. Equity investors, to say the least, are vastly underwater, as we've discussed. Yet a lot of these funds with no exposure to public market making money, such as what you're doing specifically. So saying that, are you finding it's challenging getting investors to change their habits? Like, these investors are just so fixated on the public equity markets right now, and you're down 70 to 80%. And how do you change that that narrative based on some of the conversations and people that you're meeting with?
Yeah, so I think that the universe of our investors are not in the same universe as your investors. So our investors are more alternative investors. They have an allocation to this to non-correlated assets, to things that are not hitched to the public markets. And so
Right.
I would say that of our over 1,000 investors, I would say that most of our people are more heavily into alternatives than the stock market. It's a different type of risk profile type of investor.
Right.
Generally, and this is just for whatever reason, people that are in equities induced, publicly traded, that's a type of person or mindset, and they really like doing that, and it's part of what they enjoy doing. When you become an investor in a fund like ours, you're a passive investor, and it's, for whatever reason, it seems it's two different categories of investors. So when we go out to try to do our retail campaigns for accredited investors, we would only focus on cannabis equity investors in the fact that if they've been in cannabis already, that generally means that those people that have been in cannabis, they already have gotten past the moralistic issues and any compliance issues. So we do target them first. But in reality, the universe of the people is much broader than that, than cannabis investors from the equity market. So it's really two different categories from how we look at it, and only because everything else that I've tried over the years to raise capital, that was what the case was at the time. But it shifts depending on what the stock market is. When the stock market is doing worse, and by the way, in 2020 during COVID, we went from 56 million assets under management to, I think, 120 something, basically doubled during COVID. And I think that was
why was there that much growth?
I think that people realized that there was so much volatility in the stock market. They wanted to have some alternative investments, but I think it was compounded in a good way by another factor. I think a lot of households, including my own and probably yours as well, everybody went to maximum cash liquidity initially, because we all didn't know what was going to happen for our own families and our companies and things like that. Once we felt a little bit more comfortable that things were not as necessarily as bad as they were, people were sitting on liquidity. So this was the difference of back then. So people were sitting on the liquidity, and this time they realized, look, if I'm going to go back into the market, I want to be in something that's less volatile. That was a tidal wave of new investors for us. We tapped into that.
Are we in that phase again now? Because we're not at the lows of March 2020, but I don't want to predict the future, but there's a lot of sentiment out there that we're headed in that direction again.
Well, I think the difference is that people weren't in the same position of going into max forced liquidity prior to this event happening. So, or concurrently with this event happening. I don't think that before people would sell even at a loss because they weren't sure if this was how much further it was going to go down, and they needed to have cash.
Yeah.
Now, today, I don't think that people are going to necessarily sell again at a loss to go to liquidity, because I don't think that anybody's outlook is as fearful as it was back then.
Okay. Ben,
Rob, you have some strong return profiles, as you mentioned, since inception, really, all the way to this year. This year, you're targeting roughly around 12% rate of return. So these are very strong numbers. I'm curious to know whether how the higher interest rate environment is affecting some of your clients, or just cannabis operators in general who need money, because obviously we're in a rising rate environment, and if they're on variable, obviously they're paying higher monthly payments and all that. And as we've seen on the public equity side through the earnings reports, growth is pretty much stalled out right now because there's a number of headwinds affecting the sector, including retail sentiment in the dispensary level. So what are you seeing right now? Does it affect you? Are you seeing it affecting your clients and other people who you talk to?
So I'll talk about it from the borrower side and then the investor side. So on the borrower side, we have two loan products. Our bridge loan, which is relatively a short-term loan, is 18 months. Generally, we price in enough premium in that loan to cover any potential spread that's going to be within that lifetime loan. That is, our origination team is looking at that all the time and adjusting that. Our average note rate was 15% for that particular construction type loan product, or value add as we call it. And that was market up all the way up till now. We may raise that rate to keep up consummate with what's happening in the markets. Now, on our other product, which is our fully stabilized loan product, that is a 5-year term typical product, and that is on a floating rate, and we make monthly adjustments off of SOFR. So how it's affecting our investors is that the vast majority of our portfolio is the bridge loan, and it's fixed. But as those loans are paying off and more shifting to the fully stabilized loan product that's on floating, more and more of the total amounts of assets under management income is switching over to the floating rate. And so you will see over time, and it'll take a little bit of time for that to shift over, but over the next 3 to 9 months, more and more of our income will be tied to the floating rate, but it will never go lower than what we would have been at par prior to all this environment changing. So that's what's changing there. What's interesting is that the Fed's Treasury bill rate is coming up quicker than ours is going. Ours is adjusting on the yield side, but it'll kick in. And it follows a little bit of time. So that's the one delta that I think that people are considering, but you should be thinking your thesis out, not necessarily on what today's returns are, but allocating to a specific sector for a specific reason. Okay, some of mine is going to be in public. I'm going to keep some dry powder for when the market continues to go down. I'm going to drop, 10% of my net worth is in equities, and I've got a few percent dry powder. I'm going to take a little nibbles here and here as it keeps going down. Can't time it perfectly. Another portion of my portfolio is going to be alternatives. In that alternative portfolio, it's never going to be balanced. One side's always going to be doing better than the other, but you can't keep switching back on forth on your strategy. So you make an allocation of what you think is the best case scenario, right. And as you get a better feel for it, so some of it's going to be in alternatives, and you're going to pick an asset class that you think is, one, decoupled from the stock market, and two, that is going to do better in an economic or real estate down cycle, and that would be a specialty use property category like cold storage, data centers, lab space, or cannabis.
It's
excellent.
I'm interested to see, this is such a polarizing industry, and I think whether which way you shape it, people are just fixated on this industry as a whole. But you think with this model, I'd be curious to know, what's your growth trajectory that you've outlined, let's say over the next year or so?
So we believe, we kind of know that we're going to round out this year very close to 400 million assets under management. We're closing a relatively large transaction that'll be announced probably in this month, maybe in the next 2 weeks at the latest, and some other transactions. That is going to get us almost to where we're touching 400 million. We've got more than ample transactions to get us well over the $500 million by Q1, Q2. And our goal is to get to $1 billion by the end of Q4 of next year. Wow. We have the pipeline. We have the depth of capital to get there. But the most important thing, and what we haven't talked about yet in this episode here, is that we're a debt lender. And we're secured by the property, the borrower's making payments. But in this specific, unique industry, we've been able to get equity from the cannabis tenant in many circumstances. And right now, in this environment, we are getting more than we've ever seen in our entire life. And so what that means is that not only do we have the secured debt part, and the prop secured by the property and the personal and corporate guarantees, but we also have the upside on equity transactions. So you're getting the upside, but you have no risk from it. So we didn't pay anything for it, or we wouldn't execute if we weren't in the money. So that is, you're getting both sides of it here. And some of them are public, some of them are private, some of them you would never have the opportunity to ever get a chance to be in. And so we have those relationships. And so when the market is down in the cannabis sector, we are able to say, hey, we're one of the few lenders, if anybody, that has capital right now to lend. And not only are we charging these rates, and this is what we're charged, but we're trying to allocate the capital the best way we can, and we want some equity warrants or something to offset what we're trying to do here. And so there's the origination team, works through those models, and so they might need to come in with 40% down is what we require. We might lean into it 1 or 2% less, but pick that up in warrants. So we might lend slightly higher on the loan to cost ratio. So we didn't really pay anything for it. We did lend slightly more, but we have more than ample equity protection, but we picked up warrants for that. From the borrower side, they're like, hey, that is phenomenal, because if I don't have to raise 1 or 2%, which might be millions of dollars, then I just saved myself from having to sell equity at the worst possible time, and I can enter an agreement with Pelorus. I can have either options to execute in several years or whatever that might be, and each one is negotiated independently. So it's actually very favorable to all parties, and we try to make it as equitable as possible. So in this particular circumstance, you've been able to increase your proceeds slightly by giving up some equity in your company, but it wouldn't be the same as you having to sell, or if it's options, you're setting it on a future strike price date.
And are you getting a lot of feedback from people and arrangements based on what you just outlined, like that's happening?
Yeah. So our pipeline, I would say that probably 75 to 90% of all transactions right now have that component to it, of the equity kicker is what we would call it, as opposed to, last year, the portfolio only has a total of, I think, 4 right now. And so we had prognosticated that as more and more lenders entered the space, regardless of what happened with legislation, it's going to happen, that the first thing that would go away is these equity kickers. But what's really happened is it's gone the other way, because all the rest of the lenders are really struggling to raise capital
100%.
right now.
That was the feedback.
That'll change. That'll change, but you would want to be in our book now as an investor to pick up all these upsizing. And just so you know, we allocate every single month. We are utilizing Black-Scholes model for publicly traded, or we're using price discovery for private transactions. And every single month we allocate that, or we price the value of those unrealized gains, and we allocate those to the fund members. So fund members that have been in for 2 years before that transaction came to a liquidity event get a different allocation than somebody that just came in that last day before it happened.
Gotcha.
Now, last question on my end, Rob, is you mentioned that interest was very high, an all-time high, in fact, to use your own words, which is great. Now, I wanted to know, with the midterms coming up and I think 5 ballot initiatives that are going to, where voters are going to vote for cannabis legalization or rec use allowance in their states. Are you starting to see are you seeing an uptick in demand from those states that could prospectively go legal in November, or of course contingent on the outcome of the ballot?
Yeah, so I'm not on the origination team, but I could speculate, because I used to be on that side as well at one point. Generally, we have people that are coming to us that have options to go to purchase properties prior to those states becoming medical. Usually it goes medical first, or a new region that's becoming available. It would be a very poor bet to buy the property hoping that it happens. That is not something that we would think was a great strategy. But we look at transactions. It happens all the time. But remember, even once that state goes legal in whatever form, medical or recreational, whatever is happening there, it takes time for that stuff to roll out. Generally, when a new state comes online, it takes time for those rules and regulations and licenses to be issued. So it could still be a couple of years before we see transactions start rolling through there. And so generally, for those people that are in those states that are really trying to get in front of it, a lot of them are just working out of straight equity and buying the properties and hoping that it changes and doing what they did. And by the time they get to us, by the time they got their license issued, there's some that didn't ever got the license, and now they're trying to figure out what to do with that property. And there's other people that did get the licenses, and once they have the license, we can then move forward on lending for them on that transaction.
How many states are you currently working with right now, as far as partners?
Oh man, we've done 8 states. I don't know how many we're in right this second, but we're about to add 2 more new states that we haven't been into before, and actually, I think another state. So we'll have a total universe of states of probably 11 that we've ever lent in. We're willing to go in any state. It's different as a lender than an operator. We just are simply looking for the most experienced operators with the strongest sponsors across the country. And we see probably 5 deals a day. And so we're looking at it in a different perspective. We are not trying to put a flag in each state to say that we've done a deal there like a cannabis operator is. We are simply wanting the best performing loans that we have in our book with the strongest, sponsors and great operators.
Wow. Great story, especially during these times. It's kind of nice to see a little bit of sunshine up in the sky, right? But congrats, obviously, on the just the work and growth that you've had over the past, especially the last, 3 to 6 years, but most importantly since COVID. That's big growth, to say the least. But regardless of legislation, it really doesn't matter with what your model is built on, from what I'm gathering, correct?
That's correct. And regardless of what happens, 2023 is going to be a epic year for us.
Wow.
There's things that we have always been at the forefront. We were the forefront to convert to a private mortgage REIT, the first to get FDIC insured specialty lines of credit at institutional rates, the first to get investment grade rated, the first to bring on investment grade our institutional investors for our unsecured bond. We've got more firsts that are coming out that'll roll out through 2023 that will we've just, none of our competitors have ever been able to keep up with what we're doing. And it's not that we're smarter, it's just that I think that we didn't know that we couldn't do it, and so we just went and did it and figured out how to make it happen. And I think that
there's got to be more to it. There's got to be more to it than just that, though. Like, why do you think?
Well, I think that our team that is working on this and the third parties that we use are the best in the nation. Some of them probably the best in the world. And we pay a premium to use the very best, but I think that our team members too are some of the best of people at solving problems and coming up with an idea to move through. And then we design that strategy, and then it's a matter of finding the people that can push it through and make it happen. And not always are we able to be successful, but the things that we've been successful at are so major.
It's good stuff. If I'm an investor or an accredited investor, and I'm interested, obviously, in your story, where do I find more information?
Yeah, the easiest way is just to email at IR for investor relations at PelorisEquityGroup.com. That's our website and our email address. And Pelorus is spelled Pelorus, and then the word equity group spelled out.com. So if from the investor relations side, just IR, and if it's a borrower, they send it to info at Pelorus Equity Group. And you can go on our website. It's hard to keep our website up to date because we're moving so quickly, but we're happy to send you the most information, up to date information, if you email us.
And based out of Newport Beach, California, correct?
We have a headquarters here, and we've got a little bit more people on staff in our New York office.
Gotcha. Rob, appreciate the time. Good seeing you in Chicago a couple weeks ago, but we'll have to get the crew out to California soon so we can get face to face and see some of the investments that you've obviously committed to, but I'm sure that will be fun.
Let's do it.
All right, Ben, Rob, appreciate the time. Let's keep in touch. Hey, everyone. Thanks for watching. And if you like this video, wait until you see what we have next. Some of the best thought leaders in the verticals that we cover, from cannabis and psychedelics to cryptos and NFTs and sports wagering. So if you want to learn more, make sure to click on that bell for all notifications. And don't forget to subscribe to our channel. Thanks for watching.